Our next speaker here on day 3, The Future of Money, is Malika Paul Raj. She is an expert in investment and also the author of a bestseller, How the Best Invest, Make Confident Decisions Like the Investing Superstars, which is also the title of her session. She is the founder of 4-Minute Investing and often gives advice in social media and her blogs to the everyday investor. Her own painful past in learning to manage investments led her to create an investment education platform. She was educated at Stanford University and the London School of Economics and has worked in Silicon Valley, Wall Street, and in the City of London. Malika shares her journey from Silicon Valley to Wall Street to becoming an investment specialist and stresses the importance of taking ownership of your money, as well as what she calls the 6 C's of investment, and one of them being confident, another one being calm, because we so often make those emotional decisions about our own financial future. So enjoy the session, learn some practical ideas and tips on how to invest like superstars. Welcome, Malika, to the Inspired Conference, and thank you very much for making this time available to us, for sharing your wisdom and your insight that is so fantastic in this field of investment.
Thanks so much, Marie, for inviting me. We've had so many conversations, so I'm excited to be part of this. And, it's fantastic to see how your conference has evolved.
Thank you. It's a new idea, and it's looking at utilizing the opportunities that sometimes come out of crisis. And I'm sure as an investor, that's something that you can also share with us during the course of this conversation, that it's not always just doom and gloom, but that you should look at what opportunities do come or are born in times of disruption. So, yes. Malika, you, the author of a best-selling book, How the Best Invest, Make Confident Decisions Like the Investing Superstars. And that is quite an interesting title. And I am also intrigued by your blog posts and the little videos you are sharing and the metaphors and the stories that you are using when in teaching people about investment. So I'm sure that the audience will be fascinated to hear some of your ideas around this field. So one thing that really stands out for me is your sense of humor that you are using, which is quite different to some investment blogs and investment portals that is just all about numbers and figures. And so can you tell us a little bit, what brought you from a Master of Science from the London School of Economics and Political Science to actually becoming an investment guru, and maybe share a little bit about your story.
Okay, so I was very quantitatively educated. So on the numbers side, I had a very, very strong quantitative background. I went to Stanford and I worked in Silicon Valley for a couple of years as a programmer and chip designer. And then I worked at Lehman Brothers in New York City, the now defunct investment bank. Then I came to London to do a master's degree, and then I ended up working in what they call hedge fund land here, in the environmental, social, and governance space. I was an ESG analyst for many years, doing carbon funds and ratings of companies. So that was about 15, 16 years of experience, but I never learned how to invest $100,000 or $1 million, which is what most people have in their kitties. I could definitely move around billions of dollars, like on spreadsheets of other people's, fancy money, but I didn't know how to just take a small pot, or even if it's a large pot, if it's your pot of money that you have a lot of emotion tied around it. And then when I had my first child, I had a little bit of time to think about things. And I was trying to help my parents invest their money. And we went out and started speaking to wealth managers. And I was like, there's a lot of terms being thrown along. There's a lot of asset allocation and Sharpe ratios. And I understood all these terms theoretically because I'd worked in it for so long. But they weren't getting to the heart of the issue, which is like, how do you make these decisions? How do you make better investing decisions? How do you actually press the go button and decide what plan suits you and who suits you? And I realized that even though my friends were very smart, from a very smart set, no one really knew the answers. So I started following the guys who seemed very good at it, and they recommended value investing to me, which is what Warren Buffett does, and I went into that. And I thought, what can I contribute to the space? So I just started blogging, and I just kind of, so I still run a blog called 4-Minute Investing, and I send it out every Sunday, and now it's videos, but it used to be verbal. And it was just a way of getting one idea across. I knew people had very short attention spans, and I wanted to storify things, like make things into stories. And I just decided to bring my personality into it. I've always been sort of cheeky or being very sarcastic, you know, not in an office situation, but outside. So I thought, why not combine the two? And I started, and people responded to it. And a couple of my first subscribers were people who could get investment advice from anyone, and they were, you know, very good at investing themselves, and they said, this is really good, like carry on doing this. So I got that initial encouragement, which made me be brave and keep going. So I kept going, and I turned that into a book. And I think fundamentally I was inspired by my father, who's very heavily quantitative, and he has a shelf book of investment books, like, you know, full of formulas. And the only investing book I've ever seen him pick up and read multiple times is a very easy book called Rich Dad, Poor Dad by Robert Kiyosaki, which, you know, is, some people don't agree with some things in the book, but it's a storified book about a father and a child and how the father teaches the child. So I was like, well, people don't want to read these books with equations and graphs in it. And then there's a best-selling investment book in the UK for personal finance, and it's full of like graphs. Like, it's quite easy to read, but it has graphs. And I showed it to a friend, and they're like, I would never pick it up. If it has a graph on it, I'm not reading it on a Friday night. So you have doctors and engineers and lawyers and professionals like yourself who you will do the hard work of thinking for your own industry, for your own thing. A doctor might read a medical journal. A lawyer might read a law brief, but when it comes to investing, you want something easy. Just like, you know, we've had discussions of, if you can make conferences easy, I don't actually want to go learn about a conference. I just want the service. So yeah, so that's what inspired me and kept me going. So yes, so it's been very interesting, and yeah.
That's very interesting. The connection between stories, because stories are things that people can really relate to. And as you also said, your money is something really personal to you. It's something that evokes a lot of fear, fear of loss, a sense of success if you've managed to accumulate money, and fear of taking risks. So that to me is a really interesting way of making it more digestible for people, as you say, who are not experts in that field. And
Yes.
do we necessarily also want to be an expert in everything? This is where collaboration comes in. This is where we need people like you who can offer some guidance in this really difficult world. But it's quite interesting to me because you have done all the studies, right? You've have the professional degrees, and yet at the same time you say that, you know, you learned the theory, but when it comes to the practical side of investment, that was not covered. Would you say that is something that is a big gap in studies and in the whole field of business and investment?
Yes, I think it's a huge gap. So the model of the investment industry is, hi, Almarie, you have money. I know how to invest money. Give me your money and I will invest it for you. We'll have some conversations and I'll kind of explain all the stuff I'm going to do. But basically, you're going to hand it over and I'm going to make decisions on it. And so people go into these two camps where they hand over all their money and they're constantly worrying about it because they're like, oh, the fund is down. Oh, these stocks are down. or they go into the DIY area because they're like, oh, I don't like all these certain, this type of thing. So I'm not going to trust anyone but myself. And so they go do DIY. But most DIY investors, and these can be very wealthy people, they run into a lot of problems because you have to be very disciplined, and they don't have the structures, and they could be quite smart, but if you're doing it all the first time, it's very hard. And so I think basically what I came down to is it's all the problem of the brain, and it's all the problem between being a professional investor. So obviously I live in London, and between Silicon Valley, New York, and London, I have a huge number of my base of friends is in the professional investment, some finance community, and pretty much across the board, every one of them worries what they're investing. So you have I have a cousin in New York who's a fund manager who, he literally moves around billions of dollars of some pension funds money, other people's, we call it OPM, other people's money, which doesn't affect your brain. You're just like, okay, it's a job, just like you're interviewing me, it's your job. You're not stressed about today because it's not about you. And then they can't take their 50,000, 100,000, 1 million and invest it because they just get completely frozen, and there's too many options. There's 10,000 hedge funds, there's 6,900 ETFs, there's thousands of mutual funds. And then those of us who are between two countries, like you and me, or a couple of, the minute you add a country to the mix, you have so many more options. And everyone's like, oh, go do this BlackRock thing, or go do Vanguard. But when you go to the BlackRock website, there's 2,264 funds just for UK retail investors. How are you going to pick your 3 or 4? You might have ideas, but then, so people swirl around in that indecision. So what I thought was, let me get better at making the thing I see missing is the ability to make this investment decision and the ability to press go. I know along with me, you're interviewing some other investor people in the investment space, and they have their offerings. But for the normal person starting off on this, how do they know who to choose? How do they know what they're looking for? They have to go, and people are very, very, they don't want to disclose how much they want. So they usually end up going with the first wealth manager they go to, because it's very hard to show your actual bank account and your actual how much you have in the, because we all have these images and projections of our wealth. And I come from a very conservative South Indian background, so we're always trying to underplay how much wealth we have, and some cultures overplay how much wealth they have. But everyone's always, with wealth, it's a mask. You're always playing around with something, and then you have to kind of take off your clothes in front of this wealth manager and show them what your bank balance actually is. And they go, oh yeah, hand it over and we'll do X, Y, and Z. And you're like, I don't understand what X, Y, and Z is. Everywhere the markets are falling. So I basically took a neuroscience approach to this. What does the brain say about this? Because I noticed this disparity between the professional investor and the amateur investor. And the funny thing is, I've seen so many people who've actually made a lot of money in finance when it comes to their retirement and their family money, what they're leaving their spouse and their kids, they cannot make decisions, even the basic decisions, because they know too much and they're frozen. So they can move around a lot of money in their work day, but not, so that it was very fascinating to me. And I finally figured out it's how your brain works. And that's part, the first chapter in the book is about how your brain works. And I'm a very systematic person. So with the book, everything is just it's a system, but it kind of drives you to think about what you want rather than telling you what you want. So it's not a one shop fits all. It's more like you think about, okay, those are the couple of decisions I need to make. So that's what drove me, is it's very basic education, but I'm hoping, it comes out of many years of research and trying to understand how to actually grow money.
And that's really a few words that you've been mentioning repeatedly through your explanation are very emotive words, right? And it brings us back to the whole impact of emotions, feeling naked in front of this investment specialist. I think we've all been there, what's he going to think if he, why didn't I save more, or feeling embarrassed because you don't really know what's going on in your finances. Yep. Or on the other hand, that feeling of feeling lost, not knowing what to do, being afraid of
Yes.
what can go wrong. So emotions, and I know so many people who have made the wrong decisions because of being influenced by friends or by the emotions, taking impulsive decisions and not really reflecting on why have I done this or what has made me do that. So it's very interesting, and I'd love to delve a little bit deeper into what you see is the link between neuroscience and emotions and investment. But before we
Yeah.
get to that, maybe I can ask you this question, and in a way, I think you've already addressed that, but how do you become a confident investor? Because you've now shared, there's all these, feeling lost and all these funds out there and all these people. What can you give some advice?
Yeah, so my attitude towards life has always been, copy who people are doing the best at what they're doing. So, and literally, so when I was starting to think, okay, how do you actually manage this money? And there seem to be these people who are very confident investors, and they seem to make money, and they're not scam artists. They're like long term. They build wealth long term, like Warren Buffett. And I was like, okay, how? So I started to study them, and so my approach is basically this value investing approach, which is what Warren Buffett does, and he manages billions, and all the fund managers who are like him. And then I also started to look at long-term pools of capital, which are the university endowments. So you have so basically you and any asset manager, so you, Elmarie, me, Malika, against any asset manager. It could be JP Morgan, it could be Goldman Sachs, it could be Fidelity. They all have their virtues and vices, but we basically have a disconnect between what they want and what we want. So we are looking for the long term. Like, you have children, I have children. I want, I want what I build to last for generations. And I'm sure you're similar. So it's not just, and I'm in my 40s, so I need my money to last at least another 50 years. Very, very long-term thinking. Versus all the asset managers, because they're competing against each other, they're looking at their quarterly profit. So the day traders are looking for what they make today, and the asset managers are looking at what they make a quarter, because if they fail for 2-3 quarters, you're going to take your money out of there. And so they're stuck in this vicious circle of performing quarterly. So I looked at who can actually sit back and look at the market and say, okay, what is going to work for the next 3 to 5 years? We're not even talking about 50 years, the next 3 to 5 years. And I found it was the endowments and the pension funds and the long-term pools of capital, because they have enough. And so the endowments or family offices, they need to make the capital last for a long time, fund their universities, fund research. So I started looking at them, and they behave very differently from the asset managers. So really, I think it's just trying to see what the big Fidelities and BlackRocks are doing, because they're companies that, and they're good at what they do, but their time horizon is a quarter, versus our time horizon is decades at the very least, right? And even if you're your 80s, you're probably thinking of your grandchildren who are 10 years old. So, even if you're 80, your decade horizon is quite long. So I think that's the fundamental difference. And I talk in my book about the investor brain, and confidence comes from knowing what other people are doing well and then doing some for yourself. So one of my main tenets is you should be a DIY investor, and do some investing yourself, even if it's just 5% of your money, because that'll discipline you to look at the markets, and it could be in angel investing, it could be in real estate, it could be in any part. But if you're not, I have this kind of saying that if you don't take an interest in your money, somebody else will, and it's probably not a good interest. So.
So you've mentioned now a very important difference between the individual investor and the professional who's supposed to help you, and that's a really good explanation, with you having a long horizon and for them having a very short-term horizon. So it's very logical that there are differences of approach. So taking ownership of your own money, therefore, means you've got to really understand what kinds of investments are out there, how to go about it, where does one find this out? If you're a, take me as an example, this is definitely not an area of expertise. So should I now, as you said, take 5% of my money to start off with, where do I go and what do I do?
Okay. So I think, to be honest, I think my book is a good place to start because I'm asset agnostic. So what most people have, most asset managers, most wealth managers, and you cannot blame them because everyone has to be specialized. They specialize in something, right? So we think of investing as stocks and bonds, but it could also be real estate. It could also be Airbnb. That's an investment to buy something and then sweat it for cash. But if you go to your average wealth manager, they're going to go, oh, why do you have this real estate? Just buy stocks and bonds. And the hedge fund managers will have their tranche, and then the more, like if you go to PIMCO, they're very bond focused, so they'll be pushing you into more bonds. So everyone has their flavor of the day, and it's up to you to kind of know. So what I've done in my book is there's a chapter called Clarity, where I talk about ice cream sundae investing, like it's a metaphor for how you should think about building your portfolio. So that's one thing. Two, I think follow your interests, like find the investment industry always makes these false dichotomies, like DIY or wealth manager. So it's like, oh, you have to hand all your money over to this, say you have 100,000, it's like, you have to give every penny to the wealth manager, or you have to manage every penny yourself. Why not split it? Then there's this active and passive, which is like index funds versus active management. They're like, oh, you're either an active investor or a passive investor. Well, you and me, we can be both active and passive. The investment manager himself has to choose because he can't be both. He or she can't be, you can't be doing everything. You can't be real estate and stocks and this. They're all specialized, and that's fine, but you can be both. We can look at, I talk a lot about real assets. So that is businesses that give off cash, or it could be farmland or timberland. And those of us, a lot of us maybe inherit farmland, or we come from countries that maybe we have some property left over there. So that's part of our portfolio, right? But if you're sitting in London or Singapore, they don't consider that part of your assets. So how do you holistically think about it? And think about it long term. So I'm trying to give a structure there, which I call ice cream sundae investing. And then there's some very traditional investments such as gold, which I've obviously, as an Indian woman, I come from a culture that's gold obsessed. But there's a reason for it, because it holds its value. And there's lots of reasons that Indian women, that's how they carried their wealth. So that's the only thing they could actually own once they got married and went to their in-laws' houses. So it makes perfect sense if you look at it through that angle, but it also makes sense for us now. The stock market is, I know it's holding up right now as we speak, but with coronavirus, who knows where anything is going. So, but gold tends to hold its value. If you have farmland, at least you can eat off of it. You can go, if you have a house in France, you can go live in it. So, But putting all your money in gold, or all your money in a house in France, or all your money in a certain type of, that's the wrong thing, right? That shouldn't work either. So I'm trying to get people to think about that, and just ask the hard questions and be more empowered when they come to investment managers and wealth managers, because there's a sense, and it's funny, I see it with extremely smart people, that the investment specialist knows a lot, but investing is just taking some guesses, right? So if you go to a wealth manager today or an investment specialist today, they'll take your age and they'll take your retirement age, and they have this model forecasting what stocks are going to look like. And based on that, they'll say, hey, you should be in 60% stocks and 40% bonds, or, Asia is going to grow more than the US. They should have, 20% in Asia. But it's all coming out of these models, all of which are based on these assumptions. But people think it's somehow like the word of God, So the way I look at it is like, doctors are terrible investors, because if I go and get a medical test now and they say, oh, your iron is this much and your cholesterol is this much, they've tested my blood and it is that much. And if I do certain things, it can come down. So, the doctor can help me in a very repeatable fashion. Versus investing, they're like, oh yeah, try and do the 60-40 portfolio, or they give you this prescription, you, Elmarie, here, I'm an investment manager, here's my prescription for you. But based on when you invest, you could make a lot of money based on, I could put you in 60% stocks today, and then 2 months later, the market crashes, you could lose quite a lot. So how do you adjust to that? So people keep thinking some sort of exact science, but it's not. It's just some estimations. And so I try and deconstruct how these models are built. And people say, "Oh, are you against wealth managers?" And I'm not at all. I think it's a matter of interest and time. So if you don't have time, you should definitely outsource it. But the problem is people keep being annoyed at their wealth managers because they don't actually understand what questions to ask or how they're doing their work and how they're doing their portfolios. And so obviously you're going to be, if some doctor kept stabbing you and giving you these pills and telling you to do these weird things, you would get upset at them if you didn't know why they were doing it, right? So I'm just trying to get people to think more broadly.
So basically, it's another good metaphor, and that's sticking in my head now is the ice cream sundae. So what you're saying is diversify, and when you choose your ice cream flavors, you're going to choose the ones that you like and that are familiar to you. So that to me is part of what you're saying, how you should approach your investment. Now, Warren Buffett said you should do something that you understand yourself, and I think that's what you're also sharing is go through the process, invest even a little bit of your money, try to do this yourself so that you have a deeper understanding of how it all hangs around, how it all comes together, and have a diversity of investment. Never put all your eggs in one basket, such an old adage, but I think even in today that is really so true. So can you tell me you've been talking about? I've heard you say courage. I've heard you say confidence, and I've heard you say clarity. Is that related to a model that you have?
Yes. So my book is based on the Super Investor framework, which is this 5-part framework, which along with my blogging, I started doing workshops for people, and there are these 90-minute workshops. And at one point, it became very obvious what people needed and how I was thinking. So I kind of structured it that way. So it's 5 C's under the Super Investor framework. The first C is for control, which is about taking responsibility for your own money. And that doesn't mean you have to invest a penny of it. You could outsource everything, but know what you're outsourcing to, know where it's going, know what they're going to do with it. And just like a CEO of a company like yourself, like I'm sure you're doing these interviews with so many things you've outsourced, but you're like, okay, we will do this and this and this. So the first C is control. The second C is confidence, which is know what the best investors do. So that's when I talk about Warren Buffett. And I have a story in there called Santa's Elves, which is basically about how Warren Buffett makes his money. So I instead of going into numbers and valuations and long PE ratios and this and that, I just tell a story about Santa's Elves over the course of a year, which is like basically a business cycle story. The third C is calm, which is adjusting your mindset. So I think the brain has these 3 parts, the primal brain, the emotional brain, and the logical brain. And that's how we've evolved. And so the neocortex of the illogical brain is where we should make our investment decisions. But we tend to make them in the primal, which is like the fight or flight, or the emotional brain, which is like, ooh, wow, cryptocurrency, ooh, I could make a lot of money. Or like, you lose money in the stock market and you're like, I'm taking all my money and putting it in cash, which is both are probably not the right approach to do that. So how do you get yourself into the logical brain? So I talk about meditation and having a schedule and a structure. And then the fourth C is clarity, which is basically, there's all the investing terms out there. And if you look, there's all these apps where you can trade and options trading, and God knows if any of this stuff works. I'm very skeptical, but you need to know how to build that up. And so I talk about, and people think, oh, this is very precise, but it's not. You have to just think about it. So I like for myself, I advocate like a banana split, which has banana at the bottom, which is cash or gold. And then you have 3 reasonable scoops of chocolate equities, strawberry real estate, and vanilla bonds. So you have a balanced portfolio. And then on toppings, like you could have like hedge fund nuts or options and futures sprinkles or in angel investing cherry, but it should be in proportion. Like most of your money should be in safe things or market driven things. You can leave, and if you don't like real estate, leave it out. You don't have to have strawberry. If you feel bonds are not going to have returns, then you leave out the boring vanilla, but it has to be balanced. What most people do, I find, is like they have a bowl of cherries, they have a bowl of sprinkles. They just go, oh, I have this money, I'm gonna go do, onto these trading apps, and every penny goes onto the trading apps, or everything sits in cash. So it's like that. It has to be balanced. I try and get and then when I think the biggest learning from that for people is there is no one answer. So I really have to come up with these proportions and adjust it once in a while, and it has to go according to my interest. And finding reasonable people to outsource the rest too. The fifth plank of my super investor framework is checklists. So I think the value investors like Warren Buffett did very well out of the 2008 crisis, but he's the guru and the master for a reason. But a lot of the smaller value managers did very badly out of the 2008 crisis, and they found it was because they bought these companies that they hadn't gone through a checklist. They bought something with something wrong with it, which obviously when the crisis came, really took their portfolio, knocked their portfolio. So they started off with this idea of checklists. And then they started putting out, like almost as an advertisement, they started showing their checklist in public. And, like one guy's checklist will be like 20 pages long to do one company. Someone came up with an investment checklist book, which is like 450 subtopics to analyze one company. And if you're like that, you should do that. But so what I said was like, what are the basics? I've come up with a checklist of 9 basic things to look at before you make any investment. And it's more, it's not going to help you become this great stock picker, but it'll help you with your portfolio and how you should think about things.
I think it's such an important thing because so many people get caught out. There are a lot of scams out there. There are a lot of people when they, make emotional decisions, they don't have a checklist that says, okay, well, make sure that this and this and this and this is in place before you put your money in there. And therefore, a checklist is something that could really save you from making those wrong decisions. That's a great idea, and I'm definitely keen to have a look at your checklist in your book, Malika. So I think I need to put that up on my mirror, because you're sometimes astonished to read in the newspapers of people that have just given all their money to these scam artists. And I look at this and I'm wondering, why didn't you just take a breath? Ask somebody else's advice, speak to your family, instead of just going jumping into this head over heels and losing everything that you have.
I think especially now, and we have discussed this before, especially now when people are in fear, people make a lot of emotional decisions out of fear and greed. And you've been in business and I've been in business, and we've all been conned by someone or the other and made these, you're like, you look back and you're like, why did I do that? For me, it's not on investing, but it was on some business stuff. And you're just like, oh, and you go back and you think, I did it because of fear. I was fearful. And so I responded out of fear. I didn't respond from logic. And so I think the most important thing is that balancing those emotions of fear and greed. And us women, we tend to be in that fearful side. So we will like be too conservative, not put money to work, over concentrate on certain things. And then there's the other thing of greed, where people are like, oh, this app is giving me free money, and they never ask, is it really free? Or, can they just take my money from underneath? And then they see all these people, oh, this one made money from, and I think there's a lot of, it's almost like ego or macho, where people are like, oh, I made all this money on Uber, and I bought Facebook shares at $70. And yeah, but they also bought 10 other stocks that didn't go anywhere. So people always talk about their wins and not their losses. So you kind of always feel like you're not a good investor. And then this thing comes along where this guy's like, oh, this trading strategy and that trading strategy, and it's so easy. And, trading can work, but like literally you can be at Goldman Sachs working with all these computers and you still won't make money. They still have to work really hard to make money. So how are you as El-Marie or Mallika with 20 minutes free a day going to compete against those guys? You cannot. So, people don't do the basics of like, does this actually work? And the other question I ask people to ask themselves is, am I going to be the one who makes money in this? So to take cryptocurrency, which is now Bitcoin, and there are all these new coins coming online. I'm guessing in 20 years, there's going to be some people who would just make massive fortunes out of building these cryptocurrency buckets. But is it going to be you? Is it going to be you? You just have to like fundamentally ask yourself, like, this person is selling me something, but am I going to be one of the winners in this situation? And maybe if you started a cryptocurrency, those people are going to win. If you started a cryptocurrency and it's one of the cryptocurrencies that won, you're going to be a billionaire. It's just like software startups, right? Like Amazon is huge. Jeff Bezos is very, but how many in the 90s, how many companies started off trying to sell things online and they went bust, right? Or they've come along and they've been very small. Or you have even companies that did quite well, Yahoo for a bit, but then tailored off. So I was at Stanford in the late 90s when both Yahoo and Google were started, just around the time I was at the university. And I was in the electrical engineering department, so I knew people were investing in these things and looking at these things, and there was no way you could pick who the winner was going to be. I would never pick Google as a winner at that time, but they had the simple, they just got the traction, they got the market right, and then they had some good leadership. Versus, who knows, like if you think of Uber, it's such a complicated, like if Uber had come to me as an investment, oh, you're going to have all this app and it's going to call a taxi. It sounds like science fiction, but they built the technology and it works, but it's still not making money. So you have to look at, if is a company a good company, because you have companies like Tesla and Uber that are doing these fantastic things, but it's because they've raised a lot of capital, and you have to see, are they profitable? Are they going to be able to keep this up? And so you have to evaluate it. And if you don't have those evaluation skills, you should pass it on to someone else. So anytime something is too good to be true, it's too good to be true.
That's a very good statement. I think everybody should embrace that. If something is too good to be true, it's too good to be true. And you also, I also believe what you've said now in terms of making sure that you ask the question, who is making money out of this? Because so often you get these gurus who are hosting these amazing workshops, and join the workshop and you're going to learn everything about investment and pay X number of thousands for attending this. And I always look at this sometimes skeptically, saying, well, you are making X thousand times all the participants, but is any of your strategies, are these strategies really working? Do you have real proof, or are you just making money from people attending your hyped up courses? So it's just about doing the work. And mindfulness, take, as you said, your calm is important. Learn, if you know that you're impulsive in your investment decisions, maybe then what strategies can you follow? Is mindfulness, breathing, yoga, what would you suggest? Do you have some suggestions that could help you from prevent you from making these decisions?
In that case, I think you have to really work with what your skill set is. And if you're just one way I look at all these kind of trading apps and things like that is look at the Fortune 500. There are no day traders on the Fortune 500, the richest 500 people on the planet. Where are the day traders? Like, there are lots of finance people on there, but they've done value investing or real estate investing, or they've built things like Bloomberg, these data platforms. And then you have some hedge fund managers who are on there, but they're not day trading. They're doing these, they're taking these massive global macro bets, and you cannot, like, maybe until 2008 you could have had this edge, but now computers are faster than you. Like, can you, unless you think this is faster than a computer, this is the only thing, what your brain can beat things at is the only thing you should go for. So but in terms of calming yourself down, so I think there's two things, fear and greed. So I think in general, women need to be a bit more like, get in the market, go do something. I think it's about the right input into your body. Like, basically my health is based on what I put into it: water, food, too much chocolate and I go off the rails. Lots of broccoli, I stay on the rails. So the same way, I think the news sources people look at as the most important thing for investment success factors. So I don't look at the stock market on a daily basis at all. I have no idea what it did yesterday. And the really good investors I know have no clue. They might know vaguely where it is. So I think it's like take those apps off your phone, start reading things like The Economist once a week, because that's digested news. So news is good. I mean, the Financial Times is good, but they have to create a story every day. So, their journalism is about creating a story every day, because they have to say, oh, today the coronavirus numbers are X. And then tomorrow they come up with like, oh my God, today the coronavirus numbers are Y, and it's like every day have to have a story, and they have to have the human element and this and that. But actually, if you look at the coronavirus, we just have to take our lumps and let it, we're hoping for a vaccine. We can prevent it to some level, but in some, it is kind of a surrender story, right? Like we just have to let it, there's only that much we can do. And unless you want to stay at home for the next 2 years, you're taking some chance of getting it. All you have to do is like get out, wash your hands, try and do your best, and hope for the best. So I think the same way in terms of investing, it's like not following the news, taking any apps off your phone in terms of, because people will say to me, I'll see a friend for dinner and they're like, oh, Apple moved up by two points today, and oof, look, did you see Facebook went down 3.2%? And you're like, what does that even mean, right? Because the market is just jumping up and down on some random news factors you cannot tell on a daily basis. So Warren Buffett has a quote that says, the markets, in the short term, the markets are a voting machine. And in the long term, the markets are a weighing machine. So with your brain, try and be a weighing machine. A voting machine is just like, oh, it went up, it went down, went up and went down. Yeah, you get up tomorrow morning, it's something has gone down, something has gone up. That's just how it's going to be. And it's great for Twitter. It's great for people on Twitter. It's great for journalists. It's great for people on TV, because then they're like, oh my God, what's going on with this company? It went down. But over the long term, companies that actually earn cash will do well. So those are quality companies with good products, good management, that have long-term capital and long-term requirements. So, and those are very obvious companies. You're looking for quality companies that can, or quality investments. It could be real estate, it could be a company, it could be farmland, it could be just about anything that generates cash, because cash at the end of the day is how a company grows. It might have marketing to it and pizzazz and this and that, but that only lasts 5-6 years, right? After that, it's like if you see with what's his name, SoftBank. So they've been putting billions of dollars, but now they're going bust because they've been taking these large bets without looking at the quality of the companies. But obviously they had the Saudi oil money and the Japanese pension fund money that wanted to get into tech, and they were like, oh well, there's all this money that wants to get into tech, let's make up a story, and they went in. And you ask anyone in Silicon Valley, they could have told you every day for the last 5 years that was not going to work. And yet in the newspapers, it's like, oh my God, he's doing so well because he just deployed this much cash. So look at earnings, and then look at quality and earnings of what you're investing in. But at the same time, also look at what price you're paying for it. Because if you buy Amazon at $1,000, that might not be a good bargain, right? So Amazon might be a great company that's going to do really well, but if it's only going to make go up to 1,200 in the next 10 years, that's not, you only made 20%. So there's no point saying, if you bought Amazon at 100 and it goes up to 1,200, that's great. So it's about paying the right price as well. And what's happening now with the markets is, I think, I'm not quite sure of the numbers, but they've done the analysis. And they say that Amazon would take 70 years to get to the valuation it is trading at today. So Amazon's a great company, it's doing very well. We all buy stuff off of it. But for it to make the priced earnings that the market is pegging it at now, it would have to succeed like this for 70 years. To me, that sounds overpriced. And yet you have people, piling into the stock. So looking at fundamentals and finding people. So I think basically, yes, the way you change your mindset, mindfulness and calm and all that can help, and meditation can help. But the fundamental thing is what news diet are you on? And so read research letters, all the banks and the wealth managers will put out these very good, and it's analyzed because they have to show how smart they are. Read those newsletters. Don't read daily news or what the app is flashing up. It doesn't tell you anything.
Do you, in your book, Malika, give some advice as to what, you've mentioned some newsletters to read, you've mentioned some, is that something that our audience will find in your book or in your blogs? Where will they be able to find out some of this practical advice?
So I recommend reading The Economist and the Financial Times. Financial Times, it could be the Wall Street Journal. That's like the daily consumption. The weekly consumption would be The Economist. And then I think it's very good to look at investors' letters. You can find some links, yes, in my book and my blog. I always, if people subscribe to my blog, what I'm trying to do is like summarize things for people so that they don't have to go, like I'm very interested in going and reading what someone is doing, but you'd probably find it boring.
Somebody sort of curates some of this,
Great.
or because I wouldn't know where to start, but if I get that kind of advice, that saves me time, because we all have very busy lives as well. So
Yes.
we trust then on the advice, and I know, okay, I would go to this directly. But I also definitely think that what you're saying about the news is so true, not only in the financial world, but the whole COVID thing of the COVID statistics and the COVID numbers. And I sometimes wonder, do people read this with a discerning state of mind? Because once you start looking at these numbers, there's just so many questions. And do you just eat it all up? And how does it really? What does it really matter? And how does it really affect you? How many people are infected with COVID in America? I mean, but it can get you in this state of fear and worry. And I sometimes wonder why one would. I've stopped watching the news. I absolutely agree with you, because it's just senseless to do that to yourself. You've mentioned your blog, and I wanted to ask you, one of the articles that really fascinated me was Sleeping Beauty, and there was Surviving 2020, the Sleeping Beauty Care, and you actually say walking slowly in order to run fast. What do you mean by that?
I think people tend to overtrade too much, and there's a lot of people worrying about market crashes. And one of my principles for investing, I think principle number 4 is prepare for panic. So with your wealth manager, you should already have some sort of, or for yourself and you and your family should already have a plan for if the stock market falls. And if you see the stock market falls, but then it comes back up, and if you're in good quality companies, they will come back up. So I think there's a lot of people running towards cash. And so basically my advice, and this was, I think it written in February, was go to sleep for a year. Like Sleeping Beauty, just should go to sleep for 100 years. So make good decisions and then just leave it. And a couple of people have written to me saying that really saved them, because they were going to go to cash in March. But then they read that and they thought, let me hold on. So it's about long-term investing. Make the right decisions and then just leave it. If you made the right decisions, you won't panic. I mean, maybe you curate your news. I think it'll serve you well.
So that is very good advice, and I can really recommend people to read your blogs, because to me it comes back to making things more palatable, more digestible, and as you say, you use the stories as metaphors that helps people make sense of this sometimes really strange and weird world to try and understand. You spoke about Silicon Valley and being at Stanford. What's it like to be a woman in the world of investment? Have you always found that easy? Do you think there are certain prejudices that exist against women in investment?
I think women are not taken seriously in the investing world. I think I think now there are women in sales and marketing roles, and sort of selling the products. But in actual investment decision making, I think it's very, so I go to these value investing conferences, which is kind of the Warren Buffett style, and literally I am the only woman there. Dozens of these conferences, I'm like the only female present, and then there'll be one more female, if that, and then you become best friends with them because it's like the only other female. So I think, and I'm also part of the quant circle. So because of my quantitative background, I keep an eye on the quantitative finance world of hedge funds, and so I go to those events as well. And there's many more women, not a lot, maybe 5-10%, but it's not 0 to 1% in those circles. And I always wonder, there's this hard conference where you have to have like this massive physics and maths background to really attend. And then, but there are more women there than at this like stock picking conference. Why is that? And I realize it's because with education, we get to that point where we get that respect. And then, so you're allowed into these conferences with a quantitative. But I think it's very hard as women to get respect in investing. Like there's just no woman investor we look up to. And yeah, I think it's quite funny. Like, and I'm 44, so I think I have, I've got a lot of, I've seen a lot of market cycles, and I try and be objective, and yet like to get my voice heard is I think very difficult. So because
how does one change that? I mean, this day and age with a great push on inclusivity, which is also one of the themes across the 5 days of our conference, looking at inclusion and looking at,
yes.
It's just such a relevant topic. How do we change the conversation? How do we change people's mindsets around
I
this?
think everyone has the power because everyone has a pension. Most people have a pension, or if you have investing, it's usually in a big pension pot. So these pensions are massive. They're trillions of dollars or billions and billions of dollars. And they put it down to these various investment managers who run the world, like the hedge funds and everything. So your $100 a month is going up into this massive $1 billion pension pots, and they are putting it into, $1 billion at a time into all these hedge funds. You look at all these funds, they're just completely, 100% men. Maybe the woman will be on the legal team, you'll have a woman, or it's just like, or maybe on the sales team, but on the actual investment decisions, there are very few women. So actually, I think it's up to women or, male allies, as they call them, to change the pension fund, because it's our money going up. So we should insist that they put money into funds that are run by women. And two things annoy me about the space is like they basically keep doing these studies, and the FT is guilty of it, and the Economist is guilty of it, and they say women funds beat male funds, right? So women hedge fund managers beat male hedge fund managers. So you should invest with women more. But I was like, that's quite, as someone who's tried investing and was thinking, and now I'm not going to, but at some point I was thinking running a value hedge fund. I was like, that you've already given me the bar that I have to beat all the men in order to make it, So I think that's very unfair. And then two, like I know so many women who do, like not so many, but the 5 or 6 women who do run these funds, they can't find capital. So there's all this blah, blah, blah going on out there, but include women, this and that. But the women don't get through the doors. There's so many times I could have been part of some team, but I don't think they bother taking me because I'm not going to add to their credibility. So I think it's just very, very on there. And I think the men don't see the problem at all. So that's not going to change. But the people who should be seeing at the end of the day, it is our money that these guys are managing, right? It's our pension money, or it's our government money. Like as a citizen of the UK government has all these funds that are then going into this. I have a pension pot. My family has pension pots. It might be tiny, it might be 50K, but it is your money that's running this at the end of the day.
Yeah.
So we should insist as individual investors, even if it's $100 in the market, that our money is managed in a more way. And I think we have to take this thing away that, women are better investors than men, and women hedge funds are perform, because it's an impossible starting point, right? Like you have to beat all the men just to start. So
why should it always be women versus men? Why can't it just be an inclusive environment? Because we all bring different strengths to teams, and in leadership and in company development, and I mean, everybody's talking about the importance of having balance in your team. Inclusive in the sense of race and age and gender, but why in the financial world? And I think, as you say, women in a way are part of the problem, because so many of my friends that I've spoken to, and even in this conference, people would be saying that, if somebody talks about investment, what does the wife say? I'm going to talk to my husband. Why don't you take ownership? Why do you see yourself as the person? And I know some of my older friends who, they don't have no idea about the finances in their family. they just, it's my husband's business. So we actually allow that through our own behaviors. So that's a very good question. When you did that, when a pension or money is deducted for annuities or pension funds at your company, are you asking the question, or are you just blindly sort of, okay, the money goes so we should be asking those questions and educating our girls and boys. I mean, it's not just for women to help, to change the whole
it's
thinking
impossible.
around.
Like you're storming the castle, and there's one person storming the castle, so you can't take the castle because it's just built up. So you have to do different things, and that's what I've evolved to do. Is with my teaching and my work in my book writing, it's a lot of work, but it's like I know I don't have a place there, so why not make a place out? Set up my own camp. But so I think with the woman thing, it's I think women can be their own worst enemies, but it's just like, I think there's so many structural things, like money is this lost, and I don't think it's because it's a confidence issue, right? So the guys go up and they start, like I have all these 22-year-old guys who just start trading and they think they're the best trader because they've made money but everyone's made money the last couple of years. So whereas women like think about it and think about it and think about it. And so many people, I think my friends are now pushing me to get more onto the investing side. But it's taken me till mid-40s, despite my education, despite my background, to even start thinking about it. And then I think there's this pink it and shrink it attitude towards women. And I know I'm wearing pink today, but so I think the very male-owned institutions, they're like, oh, we need to get these women investors on board. So, okay, let's pink it and shrink it. We'll just make it kind of easier to understand. We'll throw a couple of women in there and that'll bring in the thing. And then it doesn't bring in the woman, right? Because they're not picking research-based, it's not being explained properly, because I think you need women at the research end of things to just really try to understand as much as the men understand, and not just be selling things. So, which has its place as well. Like that's as good as well. But I think there's this whole mentality of pink it and shrink it, and not actually seeing. And I don't think women invest. And everyone's like, oh, get into the mind of a woman. And I'm like, how is my brain that different? Or in this country, in the UK, there's a lot of boys' schools and girls' schools, and they're like, oh, because boys learn differently. I was like, really? I don't see it. My maths, I picked up the maths just as quickly. I didn't find my brain as different. And then, or there's just more overlap than there is difference, right?
Yeah.
The other thing, and I recommend this book, it's called Warren Buffett Invests Like a Girl. And Warren Buffett does say, like, he's on the record, and he's an amazing man because he does believe in diversity, not just for like saying, oh, we should have more Black people or more women people, but because it helps with investment decision making. So Warren Buffett Invests Like a Girl, it's written by a woman and breaks down why he actually makes very feminine decisions, long-term, inclusive, going for companies that just have cash flow. Warren Buffett never shoots for the moon. He shoots for steady steps up. And the thing is, he's done so many steady steps up. It's beaten all the moonshots.
If you could share, we could share the title of that book as well to the audience in the conference app. And
at the end of every chapter of my book, I have 2 or 3 book suggestions, and at the end, I have a whole book. And I think on my website somewhere I have a whole list of books. I can happily share the PDF with you.
Oh, that's fantastic. I think because it just gives you guidance, to follow somebody who can really give a recommendation of what is a good book. As you said, in this whole huge library of investment books, where do you go and what do you choose? So one more question, and that is, we have this COVID crisis, and many people believe, okay, the crisis is here, but, opportunity will come, or buy stocks now, or wait until it crashes, and then it's hard to predict what's going to happen in the future. But what advice would you give people around investment now during this time of crisis? What would you say? Take the Sleeping Beauty approach. Would you say there are things that you could start doing or should be doing in terms of investment now in this difficult time?
Yeah, so I think we are at the beginning of this still. I personally think we just have not seen maybe COVID itself is coming to an end because we have vaccines, and hopefully by the end of this year they'll announce some drug or vaccine, or at least we'll be able to protect our most vulnerable people if we're in wealthy countries. I'm not, and it's also just blowing through places like India and Brazil, and that once
South Africa as well now, yeah.
Yeah, friends, Africa, yeah, and unfortunately, as horrible as it is, once it blows through a certain part of the population, like they're saying it could be 40%. It doesn't. It's never going to take a hold again like that, because enough of us have had it. Which is awful to say. So in some ways, we're coming to the end of the actual COVID part of it. But the fact that our economies were locked down, we are not seeing. We are seeing the start of so many companies not making cash. I'm not going to go get on a plane the rest of this year probably, unless it's an emergency. I'm not booking anything, which is unusual for me. But with young kids, I can't afford to be in quarantine somewhere like yourself, So I think we're starting to see that. So my suggestions would be twofold. When the markets crashed in March, I thought they would stay down there, and I thought it would be a little bit like the 2008 crisis, where it went down and would stay down for a long time and then eventually come back up. So there are 9 billion people on this planet. Capitalism is the dominant theory. Even the Chinese Communist Party is actually a capitalistic party. So the markets are just going to be, we are going to be buying our restaurants and buying our shoes, and so that's one thing I talk about in the book, the abundance mentality. We are just going to get more and more complex as a society. Our economies are going to get more and more complex. There's so much AI and medicines, and we have all these people who are improving their lifestyles in Africa and India. They're just going to keep consuming, and so I think the markets are going to be fine long term. It's just like, where are you in the markets, and how much pain can you take? So I thought they'd stay down, but then the Fed and the government, the ECB, they just put so much money, liquidity, to just keep the whole thing floating, that's kept the asset prices up, and that could crash, and then put more money down. So I think basically, and this was my blog post from last week actually, is stop worrying about all these really long-term things like inflation and things like that. The best place to keep earning money is still shares in good companies, and that could be real estate that's good. So good companies bought at a good price is the best thing. Companies that are going to keep growing, but bought at the right price tag. So it could be a piece of real estate, but not overpaying for it. Like if you're buying in central London, you might be overpaying, but if you're buying it just outside of London, you might be getting a fair deal. So the right price and the right quality. And I think it's called dollar cost averaging. So basically you have this thing of, I don't know, I was wrong with the markets, they came back up. And now I still think they're quite frothy, and we could still be in quite a bad economic period, with all the unemployment and stuff like that. Who knows? So there's this concept in investing called dollar cost averaging, where you just put the same amount to work every single month, or every single day, or whatever you want. So I would say, just be in the markets regularly and stop looking, have a strategy in place, and then just put your $100 in a month, or your $1,000 in a month. Don't shoot for the moon with all these fancy trading strategies, or over concentrating in something, but just keep going over a diverse group, and then don't pay too much for that as well. Because I would say, so say you had $100,000 right now. So today someone gives me $100,000, and then I sit there worrying, should I put it in the market today? Oh, should I take it out? What should I do? What should I do? What should I do? The thing is to just say, okay, for the next 100 months, I'm just going to put $1,000 into the market for the next, or $10,000 a month for the next 10 months, whatever you want to do, whatever makes you feel better. And no one can, the thing is, no wealth manager can tell you this answer, because it's in your brain. It's literally up to you. What makes you comfortable, and then just say, okay, I'm going to put $1,000 a month, and that way the market goes up, market goes down, you might catch it at the bottom, you might catch it at the top, and your 100,000 just sort of goes into the market slowly and steadily. So quality, right price, and slow and steady. Just keep consistently dripping money in, because if it crashes in November, then you've only put in 4 or 5%. You've only put in 20% of your assets in
So
in
instead of
cash.
putting the whole 100,000 in,
Yeah.
rather than spread it out over a period of time. And it sounds
Yes.
like it sounds like advice that also would make, I mean, if I think of myself, it calms me down, you know. So
Yeah.
yes, I'm making these investments, but I'm not going to put all of my money tomorrow into a stock that I can take a gradual approach, and that is a really good piece of advice.
Yeah. Can I
Yes,
just end
sure.
that with a caveat around
Yes.
that? Is when someone else manages your money, they make money off of the assets they're managing. So it's a percentage. So their incentive is to make you give them the lump sum, and then they'll so you need to hand over the 100,000 and then they put it in the markets. But you could just tell them, have an agreement with them. It's like, I'm going to give you the 100,000, but I want it to go in, I want it to drip in and not
Yes.
go in immediately. So, but it's up to you to know that, you know. So, and everyone's like, oh my God, my wealth manager did this with my money and I lost half of it. And it's like, no, they did, you know, they all, you know, they have their fiduciary duty, and they have all kinds of things, but you should have known to just tell them, drip it in, and
Yeah.
not have been greedy. But it's also greedy, right? They're like, oh my God, Amazon's going to go up, so I'm going to buy all this Amazon today. But so just slow and steady. And then
it does come back to your 5 principles of being
Yep.
calm, of being in control, of, you know, the more I hear you talk, those 5 principles absolutely make a lot of sense. And
Yes.
you know, you have to take responsibility as well. You know, you are responsible and you have choices, and you have to consider this, and you have to learn about this as well. Don't just be a passive person and then blame somebody else when everything goes wrong.
Yes.
Mallika, so how can people, I mean, you've got your book and you have your blogs. Do you also give people advice? You know, could people reach out to you for investment advice, or how does that work?
I'm currently not giving investment advice because I'm not regulated to do that. But what I do is I run workshops for people, and I do one-to-one coaching to help people structure how they're thinking and help them learn what it is that makes them tick, and do portfolio reviews for them, which helps them kind of get a grips to where they are and go from there. So I will be including, I think you're kindly going to include a PDF of the 10 principles. I think I'd also said I will share Nigel, I said I'd share the first chapter of the book for free, so people are welcome to do that. And yeah, so it's basically Mallika-invest.com. You can go and find or you just Google my name and contact me on LinkedIn, or there's emails on the website. And the best thing to do is read the book, look at the bookmark. But the best thing to get to know how I think is just subscribe to my 4-minute investing blog, which is on my website. And that every Sunday you'll get something about the markets, and it's under 4 minutes, so it's hopefully digestible. And that's the best way to learn.
Yeah, because then it's, as you said, around attention span, and especially if this is not a field that you're passionate about, having it in digestible little chunks is really a good strategy of learning as well. And it gives you an opportunity to go out, reflect, and try it out, and you don't get it all in once. Mallika, thank you very much. We just want to remind people that in the conference, in the community app, the Headspace app, you'll be able to post some questions. You might see some polls that we are going to share that Malika might also post beforehand or even after, because we want to really have conversations around the future, and we want for you to make this a really meaningful experience. So if you have some questions, if you have some comments, please go in the app, participate in the community, and Malika will also provide you with some of the questions, the answers to some of your questions. We will be sending out newsletters, and we want to take the impact of this conversation way beyond just what happened today. So we would love to learn from you a month from now, or 2 months from now, or 6 months from now, how you have embraced these principles that Malika has shared with you today, and what has happened to you and you, as an investor, as a result of today's session. Malika, thank you very much for today. It was just, for me personally, very enlightening, and I'm sure that our audience will have found this session to be really useful and give them good direction towards the future of money.
Thank you, Elmarie. I think you run a very, very interesting company, and I wish you happy investing.
Thank you so much. Have a lovely day.
You too. Bye-bye.